Okay, ready, start. The RBI's latest 50 bps rate hike appears more in response to the US Federal Reserve's jawboning with supersized rate hikes and less to do with domestic factors. That is not to say headline inflation is back to its best behavior of sub 4%, and while households are forced to do the hard yards, the moot point is if we are past peak inflation, with RBI estimating the crude oil basket to average $10 per barrel in the second half of the fiscal, and if food inflation and global headwinds remain elevated, chances are price rise can have another nasty episode. If so, rate hikes will remain sharper and the road to positive real rates gets even longer. In June 2019, when the policy shifted from neutral to accommodative, inflation was at 3%, the repo rate was at 5.75%, and liquidity was in deficit. Now the surplus liquidity and projected inflation of 6.7%. Monetary policy is deemed accommodative even though we are in a rate hike cycle. That said, if inflation moderates below 6% by next March, by which point the terminal rate is expected to be at 6.25 to 6.5%, real returns may turn positive after all. Though domestic factors drive monetary policy making, global events too exert direct influence, as is evident now. The FED's outsized rate hikes widened the interest rate differentials significantly, and further hikes could see capital flight, weakening rupee and increasing inflation. While RBI Governor Shaktikant Dasa maintained that RBI doesn't target a specific level for the exchange rate, its action vary from its stated position each time the rupee hits a new low. Of course, all central banks do that, but what is concerning is our depleting forex reserves, which thus assured was largely due to revolution and not actual selling of dollars. Fair enough. But with the dollar at 20-year highs, if the currency market turmoil persists, it will test RBI's mettle. Lastly, we are yet to overcome the likelihood of a global recession and fresh fears of global financial market turmoil due to aggressive monetary policy, tightening or unsettling markets. India will likely escape any direct fallouts, but it must survive spillover effects. Accordingly, financial year 23 real GDP estimates are lowered to 7%, but as Deputy Governor Michael Patra noted, if major economies are worried about a hard landing, we are on the other side, ready for a takeoff. It also means RBI and must ensure that high rates don't stifle growth later. Stop.